As we head into the evening, the U.S. stock market has officially closed for trading on Wednesday, November 5, 2025. GameStop, ticker GME, finished the session valued at $22.15 per share. It was a relatively contained day, with the stock trading in a tight range. But looking at just that single day's price completely misses the extraordinary tension building under the surface. The expectation is that this is just a stock ticking along, a ghost of its former self. The reality is that the financial models and institutional battle lines being drawn right now are suggesting outcomes so different, they almost seem to describe two different companies. On one hand, some discounted cash flow models, based on the company's newfound profitability, are placing its intrinsic value around $35 a share. On the other hand, traditional Wall Street analysts maintain a bear case that values it closer to $11 or $12. And then there is the aggressive bull case, fueled by the company's massive cash hoard and crypto strategy, which places the value at an astonishing $120. That is the reality of GameStop today. It is not a stock. It is a riddle, wrapped in a valuation enigma, and the price you see on the screen is just the market's temporary, confused consensus. The common belief, the one you hear in mainstream finance, is that GameStop is a relic. It's the meme stock, a phenomenon that had its moment in 2021 and is now slowly, inevitably bleeding back to its fundamental value as a brick-and-mortar video game seller in a digital world. People see the stock's 12% decline over the last month as proof that the fever has broken and the retail investors who championed it have moved on. But that expectation is being directly challenged by a reality that is far more complex and, frankly, far more interesting. The idea that this is just a retail-driven anomaly is falling apart when you look at who has been buying. Recent institutional filings paint a fascinating picture. While some large index funds like Vanguard have trimmed their positions slightly, other, more aggressive players have been building significant new stakes. We're seeing names like Marshall Wace, Citadel, and Invesco not just holding, but in some cases dramatically increasing their positions. One filing for Goldman Sachs showed an increase of over 1,200% in their holdings, albeit from a small base. This isn't the behavior you see from institutions who think a stock is worthless. This suggests that a different calculation is being made. These firms aren't buying because of a post on Reddit. They are buying because GameStop has fundamentally altered its corporate DNA. What has changed? The company is profitable. After years of heavy losses, GameStop has now posted a 4-quarter streak of beating earnings estimates, including a significant beat in the most recent quarter, posting earnings of 25 cents per share when 16 cents was expected. More importantly, it is sitting on a fortress-like balance sheet. As of the last report, the company has roughly $6.4 billion in cash and cash equivalents, and effectively zero long-term debt. This is not a struggling retailer on the brink of bankruptcy. This is a holding company with a shrinking but now profitable retail arm and a war chest larger than the market cap of many companies in the S&P 500. The company has also made its intentions clear. It is no longer just a retailer. It has officially adopted Bitcoin as a treasury reserve asset, meaning a portion of that massive cash pile can be used to invest in the cryptocurrency. This move, combined with its continued, albeit quiet, exploration of digital assets and its PowerPax digital trading card platform, has completely changed the thesis. The expectation is you're analyzing a video game store. The reality is you must now analyze it as a hybrid of a specialty retailer, an investment holding company, and a crypto proxy play. This brings us to the other side of the coin, the persistent and massive short interest. This is where the story gets truly compelling for anyone watching the stock's mechanics. The expectation for a stock that is down from its highs is that short sellers have won and are moving on. The reality is that, according to the most recent data from Fintel and the NYSE, GameStop remains one of the most heavily shorted stocks on the entire market. The official short interest stands at over 70.1 million shares. As a percentage of the free float, that is a staggering 17.15%. To put that in perspective, anything over 10% is considered high, 17.15% is extreme. This isn't a small, lingering short position. This is a massive, concentrated institutional bet that the company's stock price will fall and fall hard. These are not small traders. These are large funds who have looked at the $12 bear case and believe in it. Despite the $6.4 billion in cash and the recent profitability, They're betting that the core business will eventually collapse and that the cash will be mismanaged. But here's the critical detail that everyone must understand, and it's a deep contradiction. The days to cover, or the short interest ratio, is currently sitting at 13.81 days. This is an incredibly high number. It means that if all the short sellers decided to buy back their shares to close their positions at the current average trading volume, it would take them almost 14 full trading days to do it. This creates a highly reflexive situation. Any good news, any strong upward price movement could trigger a covering cascade as shorts who are in the red rush for the exit. And because it would take them so long for all of them to get out, their own buying activity would force the price up even further. This is the classic anatomy of a short squeeze, and the 13.8-day figure indicates the risk is exceptionally high. Now for the puzzle. If the stock is so risky to short, you would expect the cost to borrow shares to short them would be astronomical. Yet the current short borrow fee rate is only 0.74%. It is perplexingly cheap. This is the central mystery for GME right now. Why is it so cheap to place a bet that has such a high-risk 14-day exit window? There are a few theories. One is that large institutions have made shares readily available to borrow specifically to keep the cost down and facilitate more shorting, believing their bear case is correct. Another is that the low volume we've seen recently is distorting the days to cover metric, and that in a high-volume panic, shorts could exit faster. What's your take on that 17.15% short interest? Is it a sign of a broken thesis, or institutions just waiting for the final drop? This is a crucial question. For investors, this is what you need to watch. Forget the day-to-day noise. Monitor that borrow fee rate. You can find this data on financial sites like Fintel or Ortex. If that 0.74% rate starts to climb, if it hits 1%, 5%, 10%, or higher, it is a direct signal that the available shares to short are drying up. That is the first sign that the pressure is building. The second thing to watch is the off-exchange short volume, often seen in the FINRA dark pool data. On many days, this number exceeds 40 or 50% of all trading, meaning a significant portion of selling pressure is happening away from the public lit exchanges. And finally, keep an eye on the official SEC fails to deliver, or FTD data. While recent FTD numbers have been low, spikes in this data, as we saw in late September, can indicate settlement failures in the system, which some retail investors on platforms like X and Reddit have long argued is a sign of market stress. Do not chase a squeeze. That is a dangerous game. Instead, understand the data. Recognize that a 13.8-day cover time mixed with a 0.74% borrow fee rate is a deep market contradiction, and a contradiction that will have to be resolved. So where does this leave us? The stock is trading at $22.15, but it is a proxy for a much larger debate. The traditional analysts at firms like Wedbush, who have been consistently negative, see the company as underperform with a price target near $13.77. They are focused on the declining physical software sales and competition from digital-first platforms. Their expectation is that of a failing business. The reality they're ignoring, or at least discounting, is the $6.4 billion in cash and the new corporate strategy. The bull case, often found in retail investor communities and more aggressive valuation models, sees that $6.4 billion as a launchpad. They see a company that has survived a coordinated attack, cleared its debt, achieved profitability, and is now repositioning itself as a strategic investment fund. They see the 17.15% short interest not as a risk, but as fuel. Comment below with what you think GameStop's real fair value is. Are you in the $12 bear camp or the $120 bull camp? The future of GameStop will not be decided by its past. It will be decided by one thing: capital allocation. What does the company, led by its chairman and largest investor, do with that $6.4 billion? Do they make a massive acquisition? Do they double down on their Bitcoin strategy? Do they buy back a huge portion of their own stock, putting immense pressure on that 17.15% short interest? This is what institutions are watching. This is the real story. The expectation was that GameStop was a dying retailer. The reality is that it has become a profitable, debt-free, cash-rich enigma with a massive institutional short position betting against it. The coming quarters will be about watching how this setup resolves, and it promises to be anything but boring.